Hello and welcome. You're tuned into MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today we are joined by Nirav R Karkera, who's the head of research at Fisdom, and the show is going to be all about the queries that you've written to us on social media platforms and have texted us as well. So Nirav, thank you so much for joining in today. And there's so many queries, so we would not like to waste any time. Let's get started and talk about the first one, because Nilesh Dabi is writing to us from Gujarat. He's done SIP of 2,000 rupees in funds like Parag Parikh Flexi Cap, SBI Contra, Kotak Equity Opportunities, and a few more. Actually, there's a long list which will come up for you on the screen, but his goal is to accumulate 2 crore rupees in 15 years. He wants to know if the said amount is achievable with the current investment amount. So this is a very specific goal that the viewer has written to us about, Nirav. What's your take first? Is the allocation okay? Will he be able to achieve the targets that he's set for himself?
So first things first, the good news is you have such a clear target. Quite often than not, not having a clear target is where most problems start. So congratulations on having a set target. I am looking at the portfolio. The funds are really good funds. I must commend you on the choice of funds. Within respective categories, these are highly promising funds. So that's one thing good going in favor of the portfolio. However, I couldn't help but notice the absence of debt mutual funds. So unless there is another investment corpus that is in fixed income or debt kind of securities, it could be a fixed deposit or a separate pension fund. You may want to explore debt funds also. It does not just cushion you in the case of a downturn in equity funds, but you could also take slightly more aggressive debt funds in terms of duration risk. Like you could allocate a small bit towards gilt funds or dynamic bond funds to slightly improve and prop up your risk adjusted returns over the period. One thing very clear is that the SIP amount that is being committed right now may not be sufficient. It could be sufficiently inadequate to say the least. So you may have to step up your SIP amount. If we were to take a ballpark assumption of 12% as a CAGR, you would need an SIP of almost 40,000 odd rupees to reach the desired figure of 2 crore rupees. So, just in case you aren't able to do it immediately, it's fine. You can always consciously step up your SIPs as and when your sources of income increase. And if there are any windfall gains, please be sure to also deploy lump sums intermittently as much as possible so that you get closer to your target figure during the target period, that is 15 odd years.
Okay, so around 12,000 rupees of SIP is what the viewer is doing every month. So good to step it up, because the targets that he has are very specific. And an important point of including debt funds in your overall portfolio, because over a longer term period, that is what will balance your overall returns as well. Thanks for that, Nirav. But let's get to the next one. Sandeep Narsimpur writes to us from Chandigarh. His monthly income is 1.7 lakh, is doing an SIP of around 30,000 rupees. He wants to know if we should increase the SIP amount, if what happens in terms of the ratios or the proportions in which he's investing versus the salary he gets. Nirav, what's your take?
Right off the bat, if you can increase the amount that you can invest, you must. I feel that is going to be a standard answer to this most standard question. If there is a possibility, so 30,000 odd rupees is approximately 1/5 of your salary, which is pretty decent. So 20% to 30% is generally what is recommended as a rule of thumb. But rule of thumbs are only as good as rules of thumb. So you must also take into cognizance your other overall personal finance situation. You must first ensure that you have enough saved up as an emergency corpus, which is basically it should cover 6 to 12 months of your expenses. After setting that aside, you must try and increase your investable amount as much as possible. In fact, if possible, increase your SIPs as and when your income level grows. There is no question about that. At the same time, you must appreciate that no matter how much you invest, you will still, fall short of what you could have otherwise achieved. So at the cost of sounding very cliched, invest first, spend later does indeed make a whole lot of sense, and invest as much as you can. Don't so while 20 to 30% is good, don't be comfortable with it. If you can bring it up to 40-50% while maintaining a good quality of life, you must absolutely do that. There are no penalties for over investing.
Over investments, it's not a term that we use often, right, Nirav? It's just that people keep stepping up as and when they feel the need. But of course, as you said, it's a very regular answer, but does need an expert advice for sure. Let's go on to the next one. Ashish is writing to us from Mumbai. He wants to know whether it is better to do a lump sum investment in any mutual funds. Will that give better returns versus an SIP? Again, Nirav, this is a question we get very often, especially after what happened last month with the market fall. And we still keep getting it. What to do with SIPs, or go all out and put in all the money that you have?
So what happened over the past few months is also very well, investor behavior is also very well captured in terms of the flows, right? You look at the October flows, you'll realize that it's not just the lump sum investments that have reached newer highs, but also the SIP book has grown significantly. And I feel that's where the answer lies. The sweet spot lies in the between. So SIPs are important from a discipline standpoint, and is important from a fundamental principle standpoint, that you will average out your cost of acquisition over a longer period. So SIPs are hygiene; they must absolutely be there. But lump sums offer an opportunity to gain that extra kicker. So during times of anomalies and where you believe nothing has structurally changed in the markets or the broader economy, but there are transitory declines in the market, or cyclical declines, while nothing fundamental has changed, you can use such opportunities to deploy lump sum investments. SIPs must be a standard hygiene. Under no circumstances must one pause an SIPs, because that will defeat the entire purpose. But with lump sums, you may have to be slightly more tactical in nature. It requires a little bit of nuanced understanding also about economic cycles and market cycles. But if that understanding is in place, either through your own knowledge or through borrowed knowledge from bona fide advisors or professionals, so deploying lump sums intermittently could definitely offer quite a kicker to your overall portfolio performance.
Okay, all right. So that's a hybrid approach that anyone should follow if it comes to investing in mutual funds. Let's move on to the next one. Rahul Jain is writing to us from Mumbai. He says he wants to invest 2 crore rupees in 2 funds. 70 lakh in a flexi cap fund with an expected return of 15%, and 1.3 crore in a debt heavy fund with a small equity allocation with an expected return of around 10% or 11%. He says the time horizon is 10 years and asks if he can make those returns with this investment style. Very specific investment amount, very specific return expectation, and very specific asset category as well here, Nirav.
I love the specificity. In fact, this just reflects how well thought through this plan has been. I feel amazing stuff. First things first, it's great that you have a very specific plan of action in place. But right off the bat, one thing that I'd like to highlight and implore is, the return assumptions are a tad bit too optimistic. Of course, we have seen historically equities deliver, largely in the range of 14 to 16%. But past performance is never an indicator for future performance. And hey, the principle of conservatism will never let you down, right? If you do indeed get the 15% CAGR, you're going to be really happy. But it always helps if you can prepare for slightly more practical scenarios. That is, a good range would be 12 odd percent, and the roots lie in our outlook on the risk-free rates and the expected GDP growth and the sensitivity that we expect equities to have. So 12% range should be a good and moderate range to set your expectations around for equities. For debt, somewhere between 8.5 odd percent debt hybrid funds should be good anchoring expectation. You can use that as a starting point. Now, these expectations are important so that you run your financial plans accordingly and you set aside amounts accordingly. So that's one. So that's on the expectation side. On the portfolio side, I realized that there are very specific allocations in mind. I generally ask people not to simply add more funds for the sake of it. More is not equal to diversified. But here, very particularly, I would ask you to go a little beyond just having 2 or 3 funds. take exposure to slightly more funds, while the number of funds is not the final objective, but achieving adequate allocation. I won't even say diversification, but allocation towards asset classes like equity, fixed income, and probably a gold/silver sort of an allocation. Please try and go beyond just two funds. It is fine. You can use hybrid funds also if you do not want to add too many funds. You can use dynamic asset allocation funds, multi-asset funds in place. That's absolutely fine. But also ensure that you are not running a fund manager specific risk or an AMC specific risk in terms of having all your money parked just in the hands of a few. So you might want to spread out just to ensure effective allocation. So this ensures effective allocation and reduces risk. Again, even at this point, under most circumstances.
Okay, I think there is some technical issue, but that was a very helpful answer that Nirav was providing us as well. So we'll do one thing, we'll try reconnecting with Nirav. For now, we'll slip into a quick break. On the other side, we have a whole host of queries that we need to discuss. Stay tuned for that. Welcome back. You're still tuned into MF Corner. We still have with us Nirav R Karkera. He's the head of research at Fisdom. We're getting very interesting mutual fund queries and we are answering them for you. Nirav, let's get to the next one. Amit is writing to us from Noida. He wants to know what is the update on SEBI's action on Quan Mutual Fund and the AMC, as the performance of the fund has been very poor in the last 3 months in the funds that he has invested in. So wants some sort of direction here.
So SEBI's investigation is still underway. From what we understand, there's no update on it, no formal update on it from either the regulator or the fund house as yet. So while this is happening, it has been sort of an unfortunate coincidence that the performance has dipped. But our understanding is that the asset management company offers or rather caters to quite a wide set of investors. So the portfolio is largely diversified across 70 lakh plus investors. The SIP book is pretty solid. Both of this indicates that there is not much of a concentration risk, which reduces chances of a run on the fund. The granularity of the fund offers a lot of respite in terms of concerns around the any run on the fund sort of a situation emanating as an after effect of whatever the conclusion of the investigation is, right? So that's number one. Number two, there is very limited reason to believe there's any causal effect between the undergoing investigation and the fund's performance. In fact, the dip in the performance can be largely attributed to the portfolio positioning that the fund house has been building since quite some time now. It's been almost 2 quarters. One would notice an increasing trend of the fund house at an aggregate level, increasing its exposure to large cap stocks and probably having among the highest level of cash, right? So these two prominent changes in the portfolios has led to a drag in the overall performance. The large cash component led to the portfolio waiting out of rally that happened in the past quarter, but it has been a saving grace in this quarter where the broader markets have been battered and it's been continuously battered since quite some time now. So this is a portfolio decision which in part turned out well for investors as well. So there's no reason for a lot of worry. This is so especially not from an investigation standpoint, because there is no reason to believe in favor of or against as yet. And as far as the performance goes, so far we believe that the decisions have been largely in line with what the fund management has been communicating. So there is no reason to panic as yet. However, this remains a wait and watch situation, and we will be continuously tracking the developments both on the regulatory side as well as the portfolio side. So we will have to keep a close watch on this fund.
Okay, all right. So this is a developing situation. So we'll get more updates only when there is a finalization here. Let's go on to the next one. Anuj Goel is writing to us from Mumbai. He has SIPs of 10,000 each in PPFAS, Kotak Emerging Fund, Quan Small Cap and Mira ELSS Fund. He wants to start another SIP for 10,000 rupees for his child and wants to know which one should he consider. Nirav, what would you suggest? Are these enough for the kind of investments or the targets that he has, that's for his child, or should he look at solution-oriented funds here?
So one good thing going in favor of the portfolio is that the choices of funds are really good. I'd like to say that right off the bat. Second, considering the longish tenure or time horizon, it does make sense to also aggressively attribute money towards emerging funds and small cap funds, which has been taken care of pretty well. Still, overall at a portfolio level, there seems to be a sort of a 50-60% orientation towards large cap, which during current cycle makes complete sense. So there are no issues over there. So there seems to be no pressing need to churn anything within the existing portfolio at least. However, for the new SIP amount, it does make sense to move away into different categories of funds. Of course, solution-oriented funds are there as an option. It does make a whole lot of sense, especially if you want to really, really lock that money in, for a longer period and want to earmark this amount very specifically. It largely solves for discipline, some of the solution-oriented funds. If that is not the concern, you could look at slightly more, aggressive bets. You can allocate a little bit of the incremental amount to an ETF like a silver ETF or gold and silver sort of a fund, just so that this in a way also helps you participate in the upside while effectively managing your downside. So that's from that perspective, and also probably allocate some to international funds. So this will also create a cushion in terms of funding for non-INR denominated goals. So if in case in future you have plans or the kid has plans to go abroad, you might want to have some sort of hedge against currency risks, and that can be effectively mitigated through investments into international funds, especially into stocks that are primarily dollar denominated. It becomes an effective hedge and a sort of a mini corpus that supports to fund that without worrying about the forex risk. So you could look at funds like the Nasdaq 100 fund. It's a passive fund, grow aggressive index, heavy on the tech side of listed universe. So you could probably allocate some of it to that also, and probably use this as the base framework to continue building the SIP book from here on.
That's very helpful, and that gives a sense of what other things you can diversify into as well, right? It just doesn't have to be equity mutual funds. You can look at other categories as well to do that. Nirav, let's go across to the next one. Gautam writes to us from Mumbai. He asks if the Balanced Advantage Fund category is better than multi-asset fund, considering the risk-reward in current rate cut environment. There's gold prices that we are seeing inching higher, and a lot of other factors as well.
So balanced advantage funds and multi-asset funds, they have a very thin line that distinguishes one from the other. In fact, a multi-asset fund is often viewed as a slightly more evolved version of the balanced advantage fund in most cases, largely. However, think about it this way: the way most balanced advantage funds are run today and multi-asset funds are run, there is a very specific trend in both categories. So the balanced advantage funds, or the BAFs, typically tend to optimize for cycles, especially in the equity and in the fixed income space. And at the same time, it is known for its adaptability and its nimble calls on allocations between equity and fixed income very specifically, right? So it's more from a nimbleness, adaptability, agility standpoint that balance advantage funds really shine through. On the other hand, you have multi-asset funds who, their primary objective seems to be to offer consistent, stable, and a visible line of returns, right, over a longish period. So multi-asset funds also move beyond the conventional equity and fixed income and have now started looking at asset classes beyond. There are a few funds that are looking at gold and silver and even probably REITs, at this point in time. So the idea is to maintain performance within a certain range. So it is not it's not a return optimization game like a balance advantage fund, but this is more of a downside mitigation or risk management fund, from a fund management perspective. So it really depends on what your objective is. I feel for longer term investors who want to effectively participate in superior risk adjusted returns on the upside, balance advantage funds, really good ones, do the trick. And for those who want to really have a lot of visibility and a reasonable sense of control on the performance trajectory of their portfolio. Of course, it cannot be completely predicted, but a reasonable sense should look at multi-asset funds. However, having said that, it all boils down to the selection of a very specific fund. It is indeed possible that a very well managed or aggressively managed multi-asset fund could outperform a balance advantage fund, or a balance advantage fund with a very conscious risk management approach could protect from downside much more effectively than any other multi-asset fund. It does finally boil down to the choice of fund, but this is the thin line of distinction at an aggregate meta level.
Okay, all right. So that is what the difference could be, a thin line of difference, but it all depends on your goals. Nirav, we have a lot more queries, but completely out of time. But thank you so much for joining in with your take today and insights as well on those individual queries. Very helpful for our viewers. Okay, with that, we'll take your leave on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.